Hello and welcome back to my CFA Level 1 channel. I'd like to introduce you to something that deals with economics, and that is currency. That is currency exchange rates. So if we're looking at foreign exchange markets, we need to deal with exchange rates, and that is there are real exchange rate, there's real exchange rate, there's a nominal exchange rate. We don't want to talk about them. We also don't want to talk about spot exchange rates and forward exchange rates. All this belongs to a different video. Here, in this video, I'd like to stress the importance of price currency, of base currency, of the effects of a rising exchange rate. So if the exchange rate rises, does the base currency appreciate? Does it depreciate? Whatever happens, we'll be watching this. So now it's quite a bit difficult because, like, for example, if we look at this way, there's the exchange rate between the dollar, the US dollar, and the European, so the euro. Let it be 1.2. So first of all, what is what? Like $1.2 for euro or 1.2 euros for a dollar? That's the first question. Now here, as we can see in the mind map again, there's the notation that we will deal with, like A per B. So A is called the so-called is called the price currency, whereas B is the base currency. So if we're dealing with this, say the dollar for euros, it means that 1 euro will buy $1.2, or a US American, an American citizen needs to pay 1.2 US dollars in order to get 1 single euro. That's the thing. So if we see it as a fraction, there's the numerator, there's the denominator. And so the numerator tells us the price currency, whereas the denominator tells us base currency. And that is that for at first glance, at first sight. So we talked about the currencies, we talked about price currency and base currency, and this will be stressed later on in like a minute or so here in the quotations, the direct quote and the indirect quote. So like if I tell you again, the exchange rate is going to be $1.2 for 1 euro. It's always for 1 single unit of the denominator. So if there's a fraction, it is always like a thing in the numerator always refers to the denominator. It's always per 1 unit of the denominator, that's for sure. Now, talking about direct quote and indirect quote, is that the 1.2 thing, this number 1.2, is it a direct quote? Is it an indirect quote? That could be one question. That could be a CFA Level 1 exam question. Now, the answer is this. There is no answer. There is no clear answer because from the United States perspective, it is a direct quote. It is a direct quote, right? And seen from the European perspective, it is an indirect quote. So there is no such thing as the exchange rate. There is always two. There's always two exchange rates, the direct quote and the indirect quote. And that's dependent on the perspective, like the country you're living in. That was that. And now the last thing I want to talk about in this video, is the effects of a currency, of an exchange rate rising. Like the direct quote, the exchange rate given in the direct quote, is at least from the United States perspective, now is going to rise, is going to go up. What's going to happen? What's going to happen? What's the effect? Like which currency is going to appreciate and which currency is going to depreciate? That's always like source of mixing it up. If an American needs to pay $1.2 for 1 single euro first, and then afterwards, after the rising of the exchange rate, he or she needs to pay $1.3. That means that the euro, that the euro like went up and the dollar went down because the American needed to pay more for 1 euro. So the euro appreciated, whereas the dollar depreciated. That's the thing. That's what I tried to see here, to write down here. The exchange rate A per B rises. That means that the base currency appreciates, whereas the price currency depreciates. And of course, vice versa. If it's the other way around, it's totally the opposite way. If the exchange rate goes down, so does the base currency. It goes down, it depreciates, whereas the price currency appreciates. So, like, think about it again. From 1.2 to 1.3, as we can see here, from 1.2 to 1.3, it is, what did I want to say? The American needs to pay more. The American needs to pay more for 1 single euro, which means the euro, the price of the euro went up. And so the euro appreciated, whereas the dollar depreciated. That's it for now. Thanks for watching. Thanks for listening. I'm Daniel Lambert, Berlin.